All right, let's dive right into this explainer. We're unpacking something that's definitely on everyone's mind lately, the sudden, incredibly stubborn comeback of inflation. We're going to move past the generic headlines to break down exactly why the economic relief we all expected has abruptly reversed course.
The reality here is pretty blunt. U.S. inflation is rising again. Just when we thought things were finally cooling down and stabilizing, boom, the trend sharply reverses. We are seeing a distinct resurgence in the metrics, which really just proves that the underlying pressures in our economy are far more deeply rooted than any of those initial forecasts suggested. And you know what makes this resurgence particularly painful? It's hitting your everyday essentials. We aren't looking at price spikes for luxury items or fancy vacations here. This inflation is firmly anchored in the unavoidable baseline costs required just to live your life and keep a household running.
So let's look at the return of inflation, specifically prices on the rise, and examine the immediate context of these spikes. New data points to a really rapid ascent across three unavoidable categories: food, gas, and housing. These are the absolute core pillars of any budget. When these three specific sectors squeeze you all at once, it severely limits your financial flexibility. I mean, you can hold off on buying a new TV, but you absolutely cannot hold off on buying groceries or paying your rent. To understand why this is happening, we need to look at energy and production costs and the massive ripple effect they create. Well, it almost always starts at the source, oil and gas. Energy isn't just an isolated sector, it's literally the foundational bedrock of the modern economy. When baseline crude and refinement costs jump up, it acts like a universal tax on every other industry. You simply cannot separate the cost of energy from the cost of everything else. This immediately makes transportation far more expensive. Think about the physical journey of daily commerce. Every single item you buy, from a gallon of milk to construction materials, has to be physically moved. The fuel premium is baked into every single mile of that journey, drastically inflating costs before product even reaches the store. And this creates a really aggressive domino effect. Production costs rising means economy prices rising. Manufacturers face higher material costs, distributors face crazy shipping costs, and retailers, they rarely absorb that hit. They pass it down. The final price tag presented to you on the shelf has to absorb that entire supply chain disruption. But supply chain costs are only half the story. We also have to look at high demand, low supply, and the spending mismatch driving all this. Here's the wild part. Despite these painful price increases, consumer spending remains remarkably strong. Driven by a really resilient labor market, economic demand hasn't evaporated at all. People are still out there participating, buying more, and trying to maintain their previous habits. That unwavering demand keeps inflationary pressures burning really hot. However, we're hitting a structural wall. High consumer demand is colliding with low supply. Whether it's lingering production bottlenecks or labor constraints, there simply aren't enough physical goods and services flowing into the market to satisfy the sustained appetite. The pipelines are constrained, but the tap is wide open. This massive mismatch acts as an absolute accelerant, forcing prices higher. It's a classic economic squeeze. When you have an abundance of active dollars relentlessly chasing a limited number of goods, sellers inherently hold all the pricing power. The market basically forces its way to a new, significantly more expensive equilibrium. Which brings us to the biggest tool in the room, the Federal Reserve's role and the era of high interest rates. To combat this stubborn inflation, the Federal Reserve has ensured interest rates remain incredibly high. This is their primary lever to deliberately cool down the broader economy. By holding rates elevated, the goal is to purposefully destroy demand. They want to make money significantly more expensive to borrow, slowing down all that intense spending we just talked about. The fallout from this is widespread. Higher rates exponentially increase borrowing costs across the entire spectrum, hitting credit cards, personal loans, and businesses. Heavily leveraged businesses are forced to pay a massive premium just to operate, which puts a severe drag on corporate growth and hiring. And honestly, that is exactly the friction the Fed is trying to engineer. So, how does this macroeconomic tug-of-war translate to the impact on your wallet and your daily cost of living? Because of all these converging factors, everyday Americans are paying significantly more just for basics. The literal daily cost of existing is climbing. Wage growth is often struggling to genuinely outpace this persistent inflation, which means true purchasing power is actually shrinking for a lot of households. Your paycheck simply does not stretch nearly as far as it used to. It's a brutal double whammy. You have rising credit card interest versus expensive loan repayments. Not only are the physical goods costing you more at the register, but the debt you might be forced to take on to float those costs is hitting you with steeper interest penalties than we've seen in years.
Simultaneously, your hard-earned savings are steadily losing value. Because a dollar today buys measurably less than it did a year ago, this sticky inflation acts like an invisible regressive tax. It silently eats away at the future purchasing power of your bank account without you ever making a single withdrawal.
So, putting all these pieces together, what happens next? Let's break down the economic forecast. If this inflation continues its upward climb and refuses to stabilize near the target, more rate hikes are entirely possible. At the very least, they might hold rates much higher for far longer than anyone initially anticipated. The Fed has made it crystal clear. They will do whatever it takes to force the economy to cool down. And that leaves us with one critical, overarching question. Will the economy finally slow down? Will this relentless combination of elevated prices and punishing borrowing costs eventually break consumer resilience and force us into a hard landing? The Fed is walking an incredibly narrow tightrope right now, and the margin for error is shrinking by the day.